Welcome back. My name's Chris Gosselin. Today I'm talking to Rob Gregory, CEO of the Glenmore Australian Equities Fund. Rob's fund has an impressive track record. Stretches back over 5 years, it's returned 25% in the last 12 months, and it tops our tables of small to mid-cap funds on Australian fund monitors for both 3 and 5 years, returning over 18% per annum over both 3 and 5 years. Rob, welcome, and tell me about the fund in general and the strategy in particular.
Thank you, Chris. It's an Australian equities fund, long only. The mandate's pretty wide. It can invest in small, mid, large cap stocks. Over the 7 years, or just under 7 years it's been running, there's probably been a bit more of a focus on small to mid cap stocks, but certainly that ability to invest in any market cap has been very helpful over the journey. The strategy is pretty much bottom up, style neutral. So it's not really value, not really growth, but really looking for high quality businesses that are mispriced by the market. And typically that has come from a company having what I perceive to be very strong earnings growth coming up in the next 1, 3, 5 years that is not correctly priced in by the market. So really looking for good businesses that can deliver earnings in excess of market expectations.
Rob, just over the past 12 months, you've been investing in the consumer discretionary sector with some success. Tell me about that theme.
Yeah, look, it's a sector that I've been following for quite some years, really going back about 12 months ago when the cost of living crisis was really starting to dominate the media. You had interest rates being pushed up very aggressively, inflation rising, electricity prices were going up, rent was going up, everyone was under pressure. So what that led to was a significant sell-off in a lot of the retail stocks on the ASX. And at the time, I viewed it as a medium-term buying opportunity in the sense that absolutely the next 6-12 months earnings for a lot of those retailers was going to be difficult, but in a lot of instances the stock prices had fallen very significantly to see the stocks trading well below what I would assess the medium-term value to be. So that was sort of the catalyst to look into the sector. Was really my belief that the conditions that were particularly tough 12 months ago, they were probably unlikely to last for a significant period of time. So it created a buying opportunity.
Just run through some of the specific stocks you invested in.
3 stocks that the fund's done well from over the last 12 months is Nick Scali, which is a well-known furniture brand in Australia. Adairs, which is a homewares, furnishings, bed linen, Manchester company that operating in Australia and New Zealand, and also Universal Stores, which is a youth-focused apparel company. So, I mean, they're 3 stocks that all fitted the bill in terms of business quality and, 12 months ago, very cheap valuation.
Nick Scali has made a significant acquisition overseas recently. You see that as being positive?
Yeah, I do. I mean, it's very early days. It was only announced last week. A small capital raising alongside that announcement. I think given, the company's really strong track record in value creation over a number of years, or a long period now, both in Australia and New Zealand, I think it's realistic. I think it's fair to assume that they'll make a good fist of it over in the UK. They haven't risked a huge amount of their market cap on this expansion into the UK. But certainly from listening to Anthony speak last week on the conference call and just looking at some of the metrics, it absolutely looks like a very, potentially a very interesting opportunity. Nick Scali's gross margin in the recent result was 65.5%, which is very high versus peers, versus Fab Furniture's, which was around 41%. So I think there's huge scope to increase margins. So I think there's, a lot of potential there with Fab Furniture.
There's a lot of talk in the media about interest rates staying higher for longer. Do you think that's going to damage that particular sector? And you're obviously not only invested in that sector, but is it going to cause an issue for that sector?
My view is, we're probably looking at interest rates being flat or maybe one or two more interest rate hikes the next 12 to 18 months. That wouldn't be a showstopper for these retailers, but it would be a minor negative. But I think what makes me comfortable with these stocks is the valuations right now are still very reasonable, and their earnings are still, they're not bottom of the cycle, but we're certainly not near the top end of the cycle where things are really frothy.
On the other side of that, you've got stage 3 tax cuts coming up. You've got wage rises running much higher than the RBA would like them, probably where the government wants them. So the government's going to continue supporting that. So I would presume that's going to offset to some degree the higher interest rates and the inflation. Do you see it that way?
Yeah, I would agree with that. I mean, one thing that's been noteworthy the last few years is even the cost of living pressures and the interest rate hikes, and petrol price going up, electricity. That's all very well documented. But it's also important to keep in mind that unemployment's unbelievably low. So for a retailer, if you've got a good product that is well targeted to your consumer, then the environment is still healthy enough for you to make sales. So yeah, I mean, I think one or two more rate hikes, not great, but not a showstopper given unemployment's still so low.
Outside the retail sector, are there any particular areas that you're looking at, or you think that have good tailwinds, or possibly headwinds that you'll avoid?
Yeah, I wouldn't say there's any sectors I'm avoiding. I mean, I think parts of resources look quite interesting just because they didn't have a great 2023 in a lot of instances, but certainly some of the coal stocks look quite cheap, and I think we're now at a stage where coal prices have bottomed. A listed fund manager, GQG Partners, which is a US-based fund manager, has performed very well over a long period of time, still trading on a very cheap valuation metric. I still continue like that. But the fund is not the fund strategy is not a big one on picking sectors and going, heavily into one sector. It's more bottom up. So yeah, I mean, some of the other stocks I'm positive on. GQG Mineral Resources, which is a sort of diversified mining and mining services company. The particular interesting thing there is it's got a very large iron ore mine, Onslow, that's being commissioned mid this year. When that really gets going and hits its targeted nameplate capacity, that's a really significant uplift in their earnings for both their iron ore business and the mining services business. So that's a stock I like. And lastly, Whitehaven Coal, which has been a stock the fund's done extremely well from over the years. They bought 2 coal mines off BHP about 6 months ago, Daunia and Blackwater. The stock really hasn't done much since the acquisition, despite it being very earnings accretive. And more importantly, it's dramatically increased their exposure to coke and coal, which I think most people would feel warrants a higher valuation than thermal coal. So Whitehaven, I think, it just trades on a very, very low valuation metric, PE multiples of sort of 5 to 6 times. So now, I mean, it's they need to go and execute and run these 2 mines, as they've targeted on the tons and operating cost basis. But I'm comfortable they can do that. So that's probably the last one I call out as being positive on.
A lot of funds either focus on industrials or resources, and you are literally across the board more. Certainly, you've mentioned a few resource stocks and coal stocks there, industrial stocks, financial services. So it is broadly based, which I think is quite attractive from the investor's perspective.
Yeah. Look, I mean, that's always been since the fund I worked at before setting up Glenmore. We had a pretty open mandate. And look, resources, it will never be a big part of the fund, but there are times where I think where you can buy resource companies with good deposits, low operating cost, long life, at or near the bottom of the cycle. I think they can be quite attractive investment propositions, and they can be a nice balance for other parts of the market at times. I think having that ability to invest in a number of sectors is definitely helpful for investors.
Rob, thank you for your time this afternoon. The fund is available obviously on Olivia 123 for online applications. Any of the viewers can have a look at your profile on Fund Monitors and take a look at the performance.